Hello, investors. So when we look at the broad market performance over the past month, the broader indices has fell by about close to 6%, something slightly more than that. So there are a few major reasons for that. One was the pressure on flows. There has been pressure on FII flows in anticipation of what could be the outcome of the US election. And China has announced some bit of a stimulus, which kind of gave hopes to investors that the China growth could pick up, and that could be the next place where there could be a massive run up in the markets. And the other major event which happened was the earnings reports from companies, which was slightly subdued. So when we look at the broad sectors, the FMCG companies called out weak demand outlook in the urban areas. IT was more or less in line, but there is a good chance that the spends could pick up as the uncertainties are behind as the US election results come out and things. Auto was showing some bit of a weakness, especially in the passenger vehicle and the commercial vehicle side. And government capex is yet to pick up in a meaningful way. So some of this has to do with the shifting of the festive season. So on a like-to-like basis compared to last year, the festive season has shifted by a month's time. And therefore, the base quarter numbers are slightly on an elevated side. And when we look at the broad trends of what has panned out in the festive month, things does not appear to be as bad as people anticipated. And even the US election results are out at this point. And when we look at the broad sectors where there could be an impact from the US policy, which are pharma and IT. So in both these cases, their business models have kind of transformed in the last few years to ensure that even if there were some adverse policy measures, the impact on these companies could be minimal. And US would require these companies for the smooth functioning of their enterprises in case of IT services, or in case of pharma, to competitively supply drugs at reasonable cost. The Indian generic players are very much essential. So we don't anticipate things to be as bad as how the quarterly earnings print kind of showed up, especially because due to some bit of shift in the festive season and things. So having said that, we need to be keenly watching on what is happening in the current festive season. Plus, there is a marriage season which is coming up. So the demand trends in this environment should be closely observed to figure out, the market directions from here. And there is a considerable amount of selling which is coming up from the promoters, be it in the form of IPOs or QIPs. Even that could have some impact in terms of incremental moves when more supply comes to the market. So even if there were incremental flows, the overall broad markets could see some bit of consolidation, because the incremental flows which are coming into the market could be absorbed by some of this fresh supply. Valuations have been corrected meaningfully, though there was a marginal correction. The valuations still appear above average or considerably elevated in certain pockets. So in this kind of an environment, investors would be better off in staying invested in schemes which have good risk management practices and which has an alignment for long-term investing. Because when you invest based on certain fundamentals, and when you have a long-term outlook, it is very much possible that such funds would outperform in a period when markets are kind of flattish or subdued returns. So given the above average valuations, investors may consider staggered investment into equities. But it is never a good idea to completely book profits and stay out of markets, because there could be change in policy environment and things like that, which could lead to reasonable returns even uh, in the medium term. So my broad advice to investors is to stay invested and consider staggered investment for incremental investment into the equity markets. Thank you, everyone. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.